ever feel like the world of investing, it's like, well, guess what I'm thinking?
Yeah.
Today's deep dive, we're all about cutting through that noise. Timeless wisdom. We're talking the intelligent investor, Benjamin Graham, the godfather of value
It's
investing.
a classic.
And we're lucky we've got not only Graham's original insights, but we've got commentary from Jason Zweig
Oh, fantastic.
and a little blurb from a guy named Warren Buffett.
Can't go wrong with that.
Ready to get our learn on.
Let's do it. These added perspectives just make it even richer.
So intelligent investor sounds kind of intimidating, right? Like you need a PhD in economics.
Right.
But Graham, he throws us a curveball right out the gate, doesn't he? It's not just about brain power.
It's funny you should say that. He actually says it's more a product of character than intellect. It's about having that discipline, to stick to your strategy, control your emotions when the market's going crazy.
Oh, yeah.
That's what sets those successful investors apart.
So less about, being a math whiz and more about, like, mastering your own behavior. It's that whole easier said than done thing.
Right.
Especially when you're seeing, like, your stocks taking a nosedive.
Exactly. And, Graham lived through the Depression.
Yeah.
He saw firsthand how fear and greed, they can just lead to terrible decisions.
Yeah.
He's got this great quote. He says, the investor's chief problem and even his worst enemy is likely to be himself.
Ooh.
So he's basically saying, we need to get out of our own way.
That's so true. It's like we're all wired to chase those hot stocks.
Right.
Follow the crowd, even when it makes zero logical sense.
And that's where those market myths come in. The get-rich-quick formulas, timing the market perfectly.
Oh, yeah.
He saw right through all that.
Oh, tell me about it. It's like everyone's trying to sell you the magic beans. You're going to be swimming in gold by next Tuesday.
Exactly.
Yeah.
Exactly. And Graham, he dismantles these myths one by one. He talks about this strategy called the Foolish Four, where you buy the stocks with the highest dividend yields in the Dow.
Okay.
Sounds almost too easy.
Yeah, if it were that simple, I mean, everyone would be driving a Lamborghini. So what's the catch?
It just doesn't hold up.
Okay.
These formulas, they might look good on paper. They might even work for a bit by pure chance.
Right.
But they don't factor in the actual business, their true value.
Yeah.
It's like judging a book by its cover.
Yeah.
You're missing all the good stuff.
So if we're not supposed to chase those shiny formulas, what's the intelligent investor's secret weapon?
Intrinsic value. That is the core of Graham's approach.
Okay.
It's about digging into the financials, understanding the business model, their competitive landscape,
Yeah.
basically figuring out what that company is actually worth,
Okay.
regardless of all the hype.
So it's like being a detective.
A little bit, yeah.
But instead of solving crimes, we're uncovering, like, hidden value in the stock market.
That's it.
I'm liking this already. We're not just blindly trusting whatever the market feels like doing today.
Right.
We're actually doing our homework.
Yeah,
We're looking beyond just the surface
absolutely.
and trying to assess what this company is really worth.
And that leads us to one of Graham's most famous concepts,
Okay.
margin of safety.
Ooh.
He uses this great analogy of like building a bridge.
Okay.
You wouldn't just build a bridge to hold like the bare minimum weight, right?
No
You
way.
want it to be able to handle a lot more.
Yeah, you want some extra support just in case.
Exactly. You over-engineer it
Yeah.
to handle way more weight than it'll probably ever see.
Right.
And that's what margin of safety is in investing.
Okay.
It's buying a stock for significantly less than what you think it's actually worth.
Mm-hmm.
That difference, that cushion,
Yeah.
that's your protection against the unexpected.
So it's like getting a killer deal at a store.
Exactly.
You're buying something way more valuable
Yep.
than what you paid for
You
it.
got it. And this is crucial when you consider all the hype around these growth stocks.
Oh, yeah.
Graham, he was wary of those.
Yeah.
Companies with sky-high expectations, everyone's piling in, driving that price up.
The next big thing. Right.
Exactly.
But then what happened?
Well, sometimes they deliver.
Okay.
But often reality just doesn't live up to the hype.
Right.
He uses examples like Texas Instruments back in the day.
Mm-hmm.
It soared, everyone wanted in, and then crashed down
Wow.
because there was so much risk baked into those expectations.
It's like building a house of cards.
Right.
It looks impressive, but then one wrong move and poof.
Exactly. It all falls apart.
So how do we avoid that trap?
That's the million-dollar question.
Yeah, how do we find those Graham-approved bargains?
Right.
The ones with that built-in margin of safety.
It takes research.
Okay.
It takes patience.
Okay.
And a little bit of a contrarian streak.
Okay.
Graham, he loved digging through those financial statements. Yeah. Finding those companies that everyone else was overlooking.
He had a knack for it.
He did.
You're making him sound like the Sherlock Holmes of Wall Street.
A little bit.
Right.
He has this great example in the book,
Okay.
Northern Pipeline Company.
Okay.
He analyzes their holdings, and he realizes they own all these bonds.
Mm.
And the bonds are actually worth more than the company's stock price.
What?
The market was completely missing it.
No way.
They were basically selling $1 for 50 cents.
Wow.
Just because no one else bothered to look closely.
So he just swiped it up.
That's the power of this kind of investing.
Wow.
You're not gambling on the next big thing.
Yeah.
You're finding that hidden value.
Wow. Okay. That makes a lot of sense.
It's a different approach.
It does, but I'm curious, like, because Graham also talks about different types of investors, right?
He does.
Like, he doesn't expect everyone to be like, combing through these financial statements like it's some treasure hunt.
He knows we're not all cut from the same cloth. That's where this whole distinction between the defensive and the enterprising investor comes in.
So tell me more about these two personalities. The defensive investor is kind of like slow and steady wins the race.
Exactly. They're all about minimizing those losses, keeping it simple. They're not trying to beat the market,
Okay.
find the next Apple or anything.
Yeah.
They just want steady, reasonable returns.
Yeah, makes sense. Less stress, too, probably.
Oh, absolutely.
So what does a defensive investor actually do? What's their portfolio look like?
Graham's a big fan of diversification, especially for those defensive investors.
Okay.
He actually recommends a pretty simple 50-50 split.
Hmm.
50% in stocks, 50% in bonds.
Okay.
You can adjust that ratio a little bit based on your risk tolerance.
Sure.
But the idea is to have that balanced portfolio that can weather the storm when things get choppy.
So it's that old saying, like, don't put all your eggs in one basket.
Right. Spread that risk.
Exactly. Okay, that makes sense. But what about the enterprising investor? That sounds a little more my speed.
Right.
Always up for a challenge.
So the enterprising investor, they're willing to put in a little more time,
Okay.
a little more effort to potentially get those higher returns.
Yeah.
They're analyzing companies, looking for those undervalued gems.
Okay.
But, and this is key, they're still following those core value investing principles.
So it's not just like throwing darts at a board and hoping for the best.
No. They're still doing their research.
Yeah.
Making sure they understand the business. Still looking for that margin of safety.
Okay.
They're just willing to dig a little deeper.
Right. So they're like the Indiana Jones of investors.
I like that.
Right. They're not just going for like the obvious artifacts.
Yeah.
That's like really big.
Yeah.
Yes.
Looking for those hidden treasures.
Okay. I like that.
Now, one more thing Graham warns us about. The dangers of speculation.
Okay.
He compares Wall Street to a casino. All these flashing lights, promises of easy money.
Right.
But the odds are always stacked against you.
Yeah, go to a casino knowing you're probably going to lose money.
Exactly. It's that fear and greed thing again.
Yeah.
People get caught up in the hype and they forget about the fundamentals.
Right.
He tells this crazy story about an early investment he made.
Okay.
This company called Sable Tire
Okay.
made a 250% return on the first day.
Get out of here.
He thought he was a genius.
Oh, I know that feeling. Like, I should be managing billions.
Exactly.
Yeah.
But the story doesn't end there.
Oh, no.
Turns out the company was a fraud, and within months, that stock was worthless.
Oh, my gosh.
Talk about a roller coaster.
Oh.
It just shows you those short-term gains.
Yeah.
They can disappear just as quickly as they come,
Especially when you have no idea what you're doing.
especially when you're speculating.
Yeah, exactly.
You're just rolling the dice.
So what's the key to avoiding those traps? Like, how do we become more like Graham and less like, well,
The Sable Tire guy.
yeah, less
I-
like that guy?
Independent thinking. That's what he stresses throughout the whole book.
Yeah.
Don't just follow the crowd.
Okay.
Don't buy something because everyone else is.
Right.
Do your own research. Ask tough questions.
Don't be afraid to be a little contrarian.
Exactly. Go against the grain a little bit.
Okay. Easier said than done, though, right?
It takes practice,
Yeah.
but it's about being your own financial detective.
Right. Not just trusting blindly.
Exactly.
Okay. I like that. So how can we learn to think more independently about investing?
Well, Graham gives some really practical advice.
Okay.
He talks about analyzing financial statements.
Okay.
Don't worry, it's not as scary as it sounds.
Right.
He breaks it down.
Okay.
He talks about understanding the management team,
Okay.
their track record, their ethics,
So we're looking beyond just the numbers,
the whole picture.
getting a feel for who's actually running the show.
Exactly. Would you invest in a restaurant without tasting the food?
No.
Probably not a good idea.
That's a really good point, actually. I like that. So it's about looking at the whole picture. And if you're working with a financial advisor, don't be afraid to really grill them.
Ask those tough questions.
Just sure they're working for you.
Exactly.
Yeah.
You're the boss.
Exactly, not the other way around. Okay, so we're wrapping up this deep dive into the intelligent investor. What's the one big takeaway? What do you really want our listeners to remember?
The market, it's not always rational.
Right.
It can get emotional, driven by fear and greed.
Oh, yeah.
But the people who understand that,
Yeah.
who stay disciplined, who focused on that intrinsic value, margin of safety,
Yeah.
those are the investors that are going to succeed in the long run.
It's about tuning out the noise, right? Like thinking for yourself. Remembering investing is not about getting rich quick.
It's a marathon, not a sprint.
It's about building something solid.
Exactly. And the intelligent investor gives you those tools,
Okay.
that mindset.
That roadmap.
Yeah, to do just that.
And maybe a good pair of reading glasses.
Uh-huh. Always helpful.
Thanks for diving deep with us today. Until next time, stay curious, keep learning.
See you next time.